Most people think that putting $500,000 into an index fund is a one-way ticket to wealth. The truth, it's not that simple. The real challenge is understanding what your money will actually do while it's growing. Because $500,000 can grow, pay out, or even feel stuck, all depending on the index fund you pick. In this video, I'm taking $500,000 and putting it into 5 very different index funds, tracking each one year by year for the next 5 years. You'll see exactly how they perform and what they're all about. I'll show you a fund that pays over $24,000 in annual dividends, and at the end, I'll show you and John a fund that could turn that $500,000 into a $1.37 million portfolio. Let's kick things off with FSGGX. This is the one most people overlook, and while the numbers might not jump out at you, there's more to this fund than meets the eye. It owns over 2,000 companies across every major market outside the United States. We're talking Europe, Asia, emerging markets, all of it in a single fund. The expense ratio is 0.06%, and when you look at the 5-year ending balance, it finishes last in this entire video. So on paper, the case for skipping it seems solid, except the ending balance isn't where FSGGX makes its argument. Companies outside the US tend to return more of their profits directly to shareholders instead of reinvesting everything. That's just how those markets are built, which is why FSGGX carries a 2.45% dividend yield, more than double what most US growth funds pay. But the yield isn't the number that matters most here. The dividend growth rate is at 15.15% per year. That means the income you receive grows by 15% every single year, compounding on itself the entire time. Share price appreciation averages 7.72% annually. This isn't the fund you choose because you want the biggest account in 5 years. So let's put $500,000 in and see what actually happens. The account is projected to grow steadily, valued at $550,842 after year 1, $607,856 after year 2, and $671,960 by year 3. It keeps climbing, projected at $744,237 through year 4, and closes out year 5 at an estimated $825,969. Consistent, measured, and the lowest ending balance in this entire video. 1-year income comes out to $12,250. That's $1,021 landing in your account every single month just from dividends. Now watch what happens over the next 4 years as that 15% dividend growth rate really kicks in. By year 5, the same investment portfolio is now paying $24,289 a year, $2,024 a month. The income nearly doubled while the account was doing its slow, steady climb. No other fund in this video grows its income anywhere close to that pace. The account finished last. The income finished in a category of its own. Now, the one thing FSGGX can't do is own the US market. It's built entirely around everything outside it. So what happens when you go the opposite direction? Own every US stock at once and pay nothing to do it. That's where FZROX comes in, and it's unlike anything else in this lineup. In 2018, Fidelity did something the fund industry said couldn't work as a real business. They launched a mutual fund with a 0% expense ratio. Not 0.03%, not 0.01%, 0. No annual fee, no percentage taken off the top. The entire return stays with you. It caused enough disruption that competitors started cutting fees the same week it launched. For investors, that's a genuine win that's still paying off today. FZROX tracks Fidelity's own U.S. Total Investable Market Index, roughly 2,532 stocks covering the entire American market from the largest companies down through mid and small caps. NVIDIA, Apple, Microsoft, Amazon sit at the top. The other 2,500 plus names make up the rest. You're not making a bet on any particular sector or size, you're just owning the whole thing. The dividend yield is 1.01%, and it barely moves year over year. Income is not the reason to be here. The reason is 12.23% average annual share price appreciation, and the fact that you keep all of it. When you put $500,000 into a fund that charges you nothing, every dollar of growth stays in the account and keeps compounding, and you can see it playing out year by year. By the end of year one, the account is projected at $566,200. Year two takes it to an estimated $640,877. That's over $74,000 of projected growth in a single year with zero fees taken out. Year three is projected at $725,093, year four at $820,043, and by year five, the account is projected to reach $927,068. Every fraction of a percent that didn't go to fees sat in the account and compounded instead. Over 5 years, that adds up to real money. Income tells a different story. Year one pays $5,050, about $421 a month. By year five, that's risen to $6,375. The income moved by $1,325 across 4 years on a $927,000 account. If income is part of your plan, FZROX isn't the fund solving that problem. Here's the thing though, the next fund charges a small fee, a fraction of a percent, and still ends 5 years later with a higher balance than the free one. And that is FXAIX. And there's a reason it's one of the most widely held mutual funds in the world. The S&P 500 has historically outpaced the total market index over that kind of window, and the fee difference is too small to close the gap. If you've been investing for any length of time, you've come across this one. FXAIX tracks the S&P 500, 500 of the largest U.S. companies weighted by market size. Apple, Microsoft, NVIDIA, Amazon. When people say the market, this is mostly what they mean. The S&P 500 has historically outpaced the total market index over that kind of window. And the fee difference, as I mentioned, is too small to close the gap. Over $750 billion in total assets. The expense ratio is 0.02%, about $2 a year for every $10,000 you invest. It tracks a licensed external index, which is why it technically costs more than FZROX. In practice, that difference is almost invisible. What isn't invisible is the 13.5% average annual share price appreciation, which is what drives the 5-year result past the free fund. Dividends yield 1.1% and grow at about 4.93% per year. Reliable, just slow. This is a fund where the income is a side effect of owning great companies, not the strategy itself. With $500,000 invested, the account is projected to build momentum right from year one, closing at $573,011. Year two, the compounding starts to show, projected at $656,144. By year three, the account is estimated to cross $750,000 at $750,771. And year four pushes it further to a projected $858,453. Then, year five lands at an estimated $980,962, just under $1 million, and it's projected to finish higher than FZROX despite costing slightly more. The 13.5% average annual appreciation is on track to compound faster than zero fees can close the gap. That's worth understanding before assuming the cheapest option always wins. On the income side, year one pays $5,500, about $458 a month. By year 5, that grows to $6,598, around $550 a month. It's moving in the right direction, just not quickly. If you're building toward a number on the screen, FXAIX does the job cleanly. If you're expecting that number to translate into something you can spend right now, $550 a month on a $981,000 account is going to feel like a disconnect. So the S&P 500 has always been the reference point, but over the past decade, the NASDAQ has outrun it by a significant margin, and FNCMX takes that growth tilt considerably further. The numbers start looking different from here. The NASDAQ Composite isn't a pure tech fund, but tech is unmistakably in charge. FNCMX tracks around 2,900 companies listed on the NASDAQ exchange. Technology makes up about 50% of the fund. Communication services and consumer companies fill in another quarter, while healthcare and financials take small pieces of the rest. Here's what makes FNCMX different from FXAIX in a meaningful way. The top 10 holdings, NVIDIA, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, Tesla, Netflix, make up 60% of the entire fund. Compare that to FXAIX, where the top 10 represent about 39%. That concentration is why FNCMX has returned 18.7% per year over the past decade. It's also why when those names have a bad year, you feel the force of it. Expense ratio is 0.3%, higher than the others. Replicating 2,900 securities across the full NASDAQ costs more than tracking 500. Dividend yield is 0.52%, so you're not here for income. Let's jump into the projections. The first 3 years show what NASDAQ-level growth looks like in real dollar terms. $500,000 is projected to become $588,964 after year 1. Year 2 pushes it to an estimated $693,440, approaching $700,000. Year 3 is projected to clear $800,000 at $816,113. The account is building real momentum. Year 4 hits $960,135. You're close. You can see where this is heading. Year 5, $1,129,200, the first fund in this video to cross $1 million. Now look at what income does the entire time. Year 1 paid $2,600. By year 5, it reaches $3,223, $269 a month on an account worth over $1 million. The portfolio crossed 7 figures. The monthly income is less than a car payment. $1,129,200 and $268 a month sitting side by side, that's not a flaw. That's a fund doing exactly what it was built to do. Growing the account was always the only job. Income just gets left behind in the process. So, FNCMX holds 2,900 companies across the whole NASDAQ. The last fund on this list owns one sector and nothing else. It produces the largest ending balance by a wide margin and the most striking income story you'll see. That is VITAX. VITAX owns U.S. technology companies, only technology, semiconductors, software, cloud infrastructure, hardware, 324 stocks tracked against the MSCI U.S. Investable Market Index for information technology. Expense ratio, 0.09%. The top 10 holdings make up 58% of the entire fund. Morningstar classifies it as non-diversified. That isn't a warning hidden in the footnotes. It's the entire premise. You are not here for balance. You're here because you believe technology compounding for the next 5 years looks like it has for the past 10, where annual returns have averaged 22.56%. Dividend yield is 0.41%, and unlike every other fund in this video, the income doesn't just stay flat or grow slowly, it actually goes down every year. As share prices rise far faster than distributions, the yield compresses. Tech companies don't reward shareholders with dividends, they reinvest, build, acquire, and let the share price do the work. The growth here will move at a pace that's hard to ignore. $500,000 will become $613,005 after year one. Over $113,000 of growth in just 12 months. Year 2 will take it to $751,015. Year 3, $919,579. The account will be approaching $1 million without even reaching the halfway point of this timeline. Year 4, it'll cross $1,125,479, and Year 5 closes at an estimated $1,377,003. Nearly $877,000 in growth from a $500,000 starting point, the largest number in this entire video. Now the income. Year 1 will pay $2,050, $171 a month. Year 5 will come in at $1,768 or $147 a month. While the account adds $877,000, the monthly income will drop by $24. That's not a rounding error. That's the direction income moves in with this fund by design. So $1,377,003 and $147 a month. The account wins. If your life can wait on the income side while the balance builds, FITAX makes a compelling case. Now, if you want to see how I'd personally build a portfolio from scratch in 2026,